is Jana Jevcakova, and I'm a Managing Director of Corporate Governance for APAC region at Morrow Sodali, and I'll be your moderator for today's session. On the call with me are my colleagues, Andrew Vasey, Director of Corporate Governance based in Sydney for APAC region. Hi, Andrew.
Hi, Jana.
We also have Andrea Bischoff, Managing Director, who's based in Germany. Good morning, Andrea.
Good morning. Hello, everyone.
And with us is also Patrick Wightman, Cross-Border Project Manager, who's based in Spain, in Madrid. Hi, Patrick.
Hi, everybody.
You're welcome, everybody. Just a couple of admin points or technical points. The session is recorded, and we also encourage active participation. So if you do have any burning questions, please do feel free to either raise your hand or basically just put the question in the chat function, or if you if the question is really pressing, feel free to step in. But other than that, I will ask everybody who is attending today as audience to be on mute throughout the session. A little bit about the survey itself, and I'll be also sharing the screen with you with some information there. So over the next hour, or a little bit less than an hour, we'll be discussing the key findings of the Institutional Investor Survey, which Morrow Sodali conducts on an annual basis. The 2021 survey is our sixth in a row. And for this year, we had a total of 42 global institutional investors who have participated. In total, these investors manage approximately $29 trillion in assets under management, which I believe is close to 1/3 of world's assets under management. So quite impressive, I must say. In terms of the responses, those were gathered either through direct conversations with investors or an online survey. And I also mentioned that we do conduct this survey independently. A couple of more statistics around the participants here. As you can see, it's a good spread of investors across various regions, just like the audience today, that we're very excited about because we do have participants from all around the world today. So without a further ado, I will jump onto the slide with some key findings. And while I'll give you a chance to read through some of those key findings, I'll direct my first question at Patrick, because Patrick has been with us for quite some time. Has it been 7 years, Patrick, with Morrow Sodali?
Yep.
So you will remember, obviously, quite a lot. And Patrick was also involved in the Institutional Investor Survey for quite some time. And so what I'm curious about, to hear from you about is, what are sort of the key trends or things that you can, share your insights into that you have observed over the year in terms of the Institutional Investor Survey, the questions and the answers as well?
Okay, sure. Well, it would have been great if we'd had the same questions every year, but obviously the world changes quite drastically every year, and the issues that we want to ask investors change as well. So I'll mention a few of the trends that we have been able to pick up on over the years. One is that, I think this is interesting for everyone because, for me, in terms of investor-company relationship, shareholder activism is probably the most exciting. In terms of, this year, 66% of respondents said that they'd support an activist if there was a lack of responsiveness to an ESG shareholder resolution. And in last year's survey, in a similar line, kind of 45% said that they'd consider supporting shareholder proposals as an effective way of influencing companies' ESG kind of policies. So there's a situation where ESG is becoming more important, obviously, but in terms of activism, investors are getting more involved. And I think what we can see also is that there's it's not just the cheeky investors or the hedge funds, but also the more traditional long only funds investors getting involved. Going on to the topic of kind of poor strategy and weak governance may lead to investors to support an activist campaign. when investors were surveyed about the reasons for which they might support an activist campaign, poor strategic decisions ranked the highest at 63% this year, and this was significantly up from 23% when compared to last year's survey. And interestingly, weak governance ranked at 49% this year, and that was down from 64% last year. And the issue of capital misallocation ranked at 37%, and this was down from 50% last year. And also in this line, 23% of surveyed investors strongly agree that collaboration with other shareholders is an effective way to influence boards, which is almost double compared to the responses from our 2018 survey. So obviously the majority of investors we surveyed were traditional long-only ones, and we have seen this in recent examples where the traditional long-only investors have decided to get more involved, get their hands dirty in activist campaigns. And then in terms of remuneration, a little less interesting, but obviously very important. All investors agree that ESG performance metrics should be included in both long and short-term executive incentive plans. And when we asked investors in 2018 how important they found ESG performance metrics in short-term incentive programs, just under 1/3 felt it was not important. So, I mean, there's always been the trend pretty much to consider these ESG metrics in long-term plans, but now we're seeing that it's important also in short-term plans. And then just a slight change in terms of 3/4 of all surveyed investors chose TCFD as their preferred ESG reporting framework, followed by 53% for SASB. And this was down from 77% last year. And while 39% preferred kind of in-house proprietary frameworks focused on material topics, this was up from 9% last year. So I think there's like a focus on making sure that companies do less blah, blah, blah and focus more on what really is material to them. Okay, I'll pass the word to you, Jana.
Thank you, Patrick. That's a great introduction, and I must, I confirm that definitely the environmental, social, and governance aspects have certainly become much more important and much more prevalent in the decision making of investors when it comes to specifically investment, voting, and engagement as well. So with that, obviously, we definitely have seen this trend, and I can again share some of the specific statistics around ESG and how investors think about ESG when they make decisions. But Andrew, given all these trends, given the importance of ESG for investors, what has been happening on the issuer side? How have the listed companies sort of adapted or addressed these increasing preferences within ESG, and also how is Morrow Sodali helping listed companies address all of these sort of new trends?
Thanks, Jana. In terms of what issuers are doing, they're doing a lot in terms of bolstering their disclosure to try and meet investors' expectations. The difficulty is aligning ESG disclosure with financial outcomes and performance. Hence, there's been more of a move towards SASB and TCFD, given that they rely or indicate a bit more on the financial impact, because when you talk about ESG, it's a bit of a known unknown. We all know they have a financial impact or can have a financial impact, but until something goes wrong, we don't really know the cost. So it's difficult for issuers to try and navigate that. So they are looking more closely at TCFD, SASB, GRI as well, and trying to match those international standards. Sorry, I've lost my train of thought here.
Okay. So obviously we were talking about the links between ESG disclosures and financial performance, and I think nowhere has this sort of been more evident or prevalent than when it comes to executive remuneration. So with that, I'll turn to Andrea, and I'll sort of direct the next question around executive remuneration and the importance of ESG within the remuneration for listed companies and for investors as well. We can see some statistics on the screen here, and also what we have seen over the years is that discussion around links between ESG and remuneration has sort of gained quite a significant momentum. But Andrea, what are investors thinking when it comes to ESG and remuneration, and what are listed companies doing when it comes to this?
Yeah, very much like for all the ESG topics, the first priority, I think, is engagement, understand better each other's perspectives. And we're seeing in the European markets different approaches from different investors, but also from different companies. When we look at the investors in particular, then we see some German investors, for example, who have a strong preference to have ESG criteria in the long-term component of the executive remuneration system integrated, while I would say international investors are not, as the survey also shows, are too keen to have it either or to see it on both. So I think it is a little bit local specific. But overall, I think every company understands the importance. In Switzerland, for example, we're seeing half of the SMI companies already having integrated ESG criteria in their remuneration systems. And in Germany, the vast majority, if not even all by now, have done it very, very similarly. Again, it has been a key focus of engagement during the course of the last month. And we expect going forward, and this is actually another very interesting finding of our investor survey, that the way companies discuss the whole ESG topics with investors during engagements, off-season engagements, of course, it is become more and more important to integrate those topics into the big picture. So instead of having a presentation with many sections that has ESG as one section in the end, it becomes extremely important to integrate the whole ESG topic in the overall strategy, of course, then also, how it's reflected and covered and overseen by the board. And then the third part, how it's reflected in the executive remuneration. And with that, I think I'll hand back over to Jana. Thank you.
Thank you, Andrea. And I think it's very, very interesting. And obviously, Andrea just confirmed that investors, and especially in Europe, European investors are quite welcoming of various ESG metrics in short-term and long-term incentive plans. This is sort of a little bit different when it comes to Australian investors. There's been quite a hot debate, I must say, around whether companies should be including ESG in their incentive plans, mainly because there's a perception that many of the ESG metrics are day job style metrics, and they're not necessarily always linked to direct value creation and do not always have impact or links to the financial performance, depending on how a company sets them up. For that reason, one of the sort of key, I would say, approaches important for companies to consider might be using ESG as gateways or as multipliers. And those companies that have implemented sort of negative multiplier, whereby you still subject your incentives to financial performance, but if the non-financial or the ESG performance is not achieved, then there might be some reduction in the overall bonus or the vesting outcome. That has been received much more positively, especially in Australia, than rewarding specifically for a particular ESG performance metric. In the sort of APAC region, we also don't see too many long-term incentive plans having ESG metric, perhaps with the exception of safety metric, which has been historically very popular amongst mining companies and heavy industry companies. However, aside from that, that there have been some courageous companies that have it sort of introduced climate change related metrics in their LTIP last year, and it took them quite a lot of engagement effort, as well as sort of convincing to get that through. They were met with quite significant dissent at this point in time, but I do think that this is just the start of a new trend, and we will certainly see more companies considering and incorporating ESG metrics in short-term and long-term incentive plans going forward. Andrew, was there anything else that I haven't mentioned on remuneration and ESG?
I just would add that your comment about some of the perspective around ESG metrics in remuneration plans is doing your day job, but it's also sometimes perceived as you're being rewarded for doing the right thing as well, given a lot of ESG metrics are tied to ethical matters. So there's definitely a debate here in Australia whether that they purely stay in the realm of the STI or whether they should be in the LTI. And I previously was at ISS about 6 months ago and was part of a cross jurisdiction team that was actually trying to come up with a universal policy on their front of what is an acceptable weighting for ESG in the LTI. And as previously said, it really depends on jurisdiction. It's all very, everyone's got different perspectives, so quite difficult for issuer to try and appease everyone if they've got a very international register.
Absolutely. Well, speaking of different jurisdictions and different markets, we can't omit COVID and how various markets and countries have been dealing with COVID. And in fact, Andrew and I are, hailing from Sydney, from lockdown, from our homes. But obviously, COVID has had a significant and tremendous impact on companies, on their business operations, as well as on governance and how they think about various policies, including executive remuneration. One of the hottest debates that I think we had last year and still is ongoing is around taking government aids and help that many jurisdictions and countries have provided to companies that were facing significant difficulties, and paying bonuses, and that link between taking sort of help and aid whilst paying bonuses to executives, as well as paying dividends to shareholders. Andrea, what have you sort of observed in Europe, especially in Germany and Switzerland, around companies dealing with COVID overall and paying dividends, and how have shareholders received that?
I think if we look at the results of the Swiss and the German AGM season, for example, I think companies dealt appropriately with COVID. Of course, there are exceptions. Of course, there are situations where remuneration votes had very low support levels, but I would say on a broad picture, most companies addressed this. Companies who engaged with investors made very clear and had a clear outline of response, how they dealt with the issues. But of course, then we've seen companies that in a year where they've been strongly affected by COVID, not if they, let's say, had chosen to go with the KPIs that were set, then there would not have been any bonus payments for the last year. Hence, there have been some adjustments made. And we've seen really extreme adjustments by some company that received a lot of shareholder opposition. But on the other hand, we also seen companies adjusting criteria in a way to that investors even understood and did not show an issue. So, for example, if a company, short-term bonus would not have paid out this year, but they've decided to distribute an amount of shares or, LTI subscription for the long term, so that, it was not cash in the hands immediately in a bad year, but something to still recognize the hard work that I'm sure all management teams at corporate companies had to go through during COVID. So that was okay. And this was something I think that was well received by the market, but it was extremely important that, again, there was an engagement about it, that it was nicely explained, that there was maybe a shareholder that explained it in a bit more detail. So once company has managed to conducted in a way that was well perceived by investors, it was even possible to, achieve good results at an AGM.
Absolutely. Would you say that engagement played quite a significant role?
Absolutely. Yes, it played a role. It helped to, again, corporates to address the points proactively to investors. And then there was a common understanding about the approach. And that is the most important thing. And this is also something that in particular in the Germanic markets does not find a lot of space in the corporate reporting, such as the governance reports. So the engagement itself is, a nice tool to extend on that and help, as I said before, to make each other understand better.
Absolutely. And what do you sort of foresee for this financial year going forward? Is the situation improving? Do you still, do you think that companies will still have sort of similar challenges, or is it getting better?
Well, this really depends on the sector, and this also depends how the European countries deal with the, legal implementations over the next months, which at least for Germany speaking is still pretty unclear whether there will be eventually another lockdown or not. Whilst in the UK, I think it's at the moment pretty clear everything is done and the pandemic is over. So let's see. I can't really truly comment on that.
Yeah, no worries. And Andrew, how would you describe the situation in the APAC region in terms of, again, COVID, dealing with that situation, and potential also links between companies taking JobKeeper, for example, in Australia, or any other government help, and paying dividends, paying bonuses? How is that sort of situation evolving?
Well, as you're aware, in Australia, there's been quite a lot of discussion and media reports about this, where particularly retailers who were able to make a successful transition to online, and everyone was at home, so they had nothing else to do but to go online shopping, actually improved their profits quite substantially and may have received JobKeeper because of that initial shock to the system of closing all their brick and mortars and laying off or standing down staff. So there's been a few high-profile cases in Australia where I think the majority have looked back and been, okay, we didn't actually need this government assistance, so they've returned it, while a few outliers have refused to return the money to the government because they've sort of said, well, we were entitled to this at the time, we didn't know this was going to happen, too bad, so sad. And then that's raised questions around, as you said, dividend payouts, and also, but more specifically around remuneration outcomes and bonuses paid. So there was some pushback from Australian investors where there was a perception that this wasn't accounted in the vesting outcomes for certain executives, that they may have received government handouts and assistance which helped to improve the financial performance. So the other thing we did see in Australia was a lot of companies didn't hit their financials, but they may have hit their non-financials, letting that vest, either putting some downward discretion, but a lot of companies also trying to read the room and get a sense of the broader community, rather than paying cash, deferring it into equity over a 1 or 2 year period. In terms of LTI, we saw a few companies introduce restricted share units, only for a portion. So typically in Australia with an LTI, it's got some performance hurdle on it, usually financial in nature. A restricted share unit doesn't. It's there, it stays there until the end of the vesting period. there was some pushback from certain proxy advisors on that, while others were more understanding and sympathetic of it. But I think there was a bit of a discussion amongst investors of concerns that this may have opened the gate to restricted share units being commonplace in Australian REM structures, which is not the case. And we look over to our peers in the UK, where it's a little bit more widespread, and it's certainly not a popular remuneration practice in Australia.
Absolutely. And undoubtedly, executive remuneration will continue being scrutinized by investors going forward. And if anything, they're getting much more sophisticated in understanding various implications, structures. And while companies are getting creative as well in terms of these new types of awards or structures, investors are certainly wanting to see not only what companies are doing, but how and why they're doing it. And I think that's a very important point to make, because investors now really want to understand the links between remuneration or executive incentives and links to basically to business strategy, and how companies are incentivizing for the behavior that they want to see their executives to show and achieve all those results. But let's move on to one of the key points that Patrick mentioned in his overview at the beginning. Patrick, you mentioned that TCFD is becoming one of the most popular reporting frameworks, and we can certainly see, one of the outcomes of our one of the questions that we asked investors certainly shows TCFD being the most popular, followed by SASB, and then, as Patrick, you mentioned, in-house proprietary frameworks that really focus on material topics and provide quite good quality information about them. Maybe, Andrea, a question for you, and Patrick as well. In terms of companies in Europe, how are companies addressing this trend? Do you see many companies aligning their disclosures with TCFD and SASB, or are we still at the very, very beginning?
I would say we have seen over the last years a lot of companies in Europe reporting according to GRI. As you can see from the survey, it is not the top priority, at least based on the investor feedback. But we've also noticed that there is a strong pressure from some institutional investors, and of course, and in particular from BlackRock, who has pushed a lot over the last year to have companies that are on their focus list reporting according to TCFD and SASB. And I think that was actually the key driver for most companies to either consider reporting according to TCFD or SASB going forward. If not, then to at least provide a mapping that showed, the alignment and the reporting topics from those frameworks in a sort of mapping table. So we've seen this very often this year. BlackRock and other investors, I think, appreciated it. But it was mainly driven through, again, engagement. Also, the threat of some investors, including BlackRock, to voice their concerns by opposing either the discharge at the company or the election of the chairman or the other board members who are in charge of ESG topics. So we have really seen that the pressure comes from the investors, and companies are adapting to it, while other companies, obviously the ones in sectors that are more pushed by investors, they had reported at least according to TCFD previously.
Yeah, absolutely. And Patrick, do you see and observe similar trends in Spanish-speaking markets? Are companies adopting any of these frameworks that seem to be on top of investors' minds?
Yeah, the bigger names adopting TCFD and SASB, mainly TCFD. But in terms of the Spanish market in Spain, I mean, the companies have always been pretty well advanced in terms of managing ESG issues and reporting on them. And actually, it's quite an impressive market in terms of these issues. So yeah, and probably quite a good reason for that is that BlackRock tends to own around 5 to 10% of each company. So
yeah, absolutely. BlackRock with that power certainly can push for change. And BlackRock has also started taking voting action against directors, as Andrea mentioned, where they can't find SASB style reporting in companies, especially large companies, and especially mainly in the US and European markets. But I do think that it's coming to the APAC region as well. One sort of frequent question that we get from many of our clients is around CDP versus TCFD. Many companies are still participating in CDP. Many investors still do have lots of their products, valuation models, and assessments linked to CDP. However, when we spoke to investors about this kind of, CDP versus TCFD, what's the difference? What do you prefer? What we find is majority of investors who are CDP signatories are very often also TCFD signatories. And what they're telling us very often is that if there is a company that's making a decision whether to put resources, time, and effort into either CDP or TCFD, they would prefer those companies to really focus on TCFD. And one of the key reasons for this is CDP, or Carbon Disclosure Project, has been very, very modern and great for carbon disclosures when it first evolved or was introduced to the market. However, CDP is mainly focused on historical and static data and information. It does ask about targets, but it's very focused on your past performance. When it comes to TCFD, this Task Force on Climate Change Related Financial Disclosures, this particular reporting framework prompts companies to think about the future. It makes companies think about various scenarios under which they will have to test their resilience. And that's basically risk resilience when it comes to physical risks stemming from climate change, as well as the risk associated with transition to low carbon economy going forward. And what investors are basically saying at large is that TCFD style of disclosures give them much more value and much better insight into how companies think about risk management and how they think about the future overall. Talking about all these reporting frameworks, talking about environmental and social aspects and factors, we cannot omit the new trend and the new discussion around say on sustainability, and with that associated say on climate as well. In early 2021, the market has taken notice of the new trend of say on climate, which has started with a UK billionaire, Chris Horn, and his hedge fund. Say on climate movement is trying to encourage companies to voluntarily provide a proposal to shareholders to vote and express their opinion on their climate change disclosures, i.e. the TCFD disclosures. We have already seen, I believe, up to 20 companies worldwide who have voluntarily agreed and already had their meeting with this proposal on their ballot, or have committed to doing so next year. In Australia, for example, 4 large mining companies have committed to having say on climate specifically on their ballot in 2022. But overall, we have some results here for say on sustainability. And for me personally, this was quite surprising. We basically have 36% of respondents saying that they really want to introduce say on sustainability as an advisory vote, obviously not as a mandatory binding vote, which I find quite interesting. But there's still lots of investors who will say, no, let's not do say on sustainability if I'm really unhappy with how a company is managing its sustainability risks or the disclosures that they're providing. I would prefer to vote against directors specifically. So we do have this ongoing debate as to what's better, what's more efficient. But Patrick, are companies in Europe worried about this? Are they sort of taking note, and how are they addressing this trend specifically?
Well, focusing on the Spanish market, where I have most of the knowledge, this is where it's interesting that in 2 years ago, 2019, for the first time, this was introduced into the ballot, the vote on non-financial information, and the first year it was fairly light. I mean, the proxy advisors pretty much told companies that they were not going to recommend against, because this was kind of like the test case in 2019. 2020, well, actually, since the proposal's been put on the ballot, there haven't actually been any there haven't been any failed ballots. So at the moment it's fairly light, but also on the other hand, companies have been pretty advanced since way back in terms of reporting on ESG issues. I think this is probably the case for Germany. Andrea can speak about that, but also France as well.
Absolutely. Andrea, I believe Switzerland has a similar resolution, don't they?
Coming. I think in a couple of years, every Swiss company has to have a vote on sustainability. Yes, that's perfectly correct. And we've also seen first companies this year either reporting to have a vote already next year, and one Swiss company, Nestle, for example, already had this year an advisory vote on its climate roadmap. I think broadly speaking, those proposals that we see more and more coming from management in Europe rather than from investors receive broad support. But it does not mean that necessarily all investors support a say on climate or say on sustainability per se. There's, I think, one very, very important distinction that investors make when evaluating those proposals, and they really do not want that the boards delegate its oversight and responsibilities over the sustainability topics to the AGM and to their shareholders. So it is extremely important if companies consider to have a say on sustainability going forward to ensure that the responsibility continues to sit with the board. And if this is the case, like we've seen it, for example, at Vinci, then it's likely that the support levels are in the end 90s. Otherwise, some opposition has to be expected.
Absolutely. When we can't omit when we're talking about say on sustainability, say on climate, all these reporting frameworks and the new requirements for companies. Also the fact that there is quite a lot of shareholder activism around environmental and social topics and overall on ESG. Patrick, you also mentioned that in your intro around how it has changed over the years and how investors are much more attuned to activism, and they're much more sort of prepared to support a potential activist or a shareholder resolution related to environmental, social, and governance aspects. When it comes to Morrow Sodali's clients and overall companies and how Morrow Sodali helps companies in this situation, what do you think are the main sort of issues that listed companies face when it comes to activism, and how can they address those?
At the moment, in Europe, there's less of the ES and more of the G, but as we mentioned, the ES is clearly growing. And in terms of the G, we're talking about simple poor governance in terms of it. They're not able to tick all the boxes, and certainly this is a case where you have companies with a kind of a strange structure whereby they've had a significant shareholders that have been buddies for the last 30 years, but now they've been looking for help from the capital market, so that you've had these big investors come in, and they obviously follow the tick box corporate governance policies, and they say, hey, wait a minute, we want more members, we want more of a say on the board, we want more independent directors on the board, and particularly in the key committees. So we've seen people, the big investors coming in and asking for this. In the same way, poor remuneration. It's quite difficult for someone who's earning quite a lot of money to change his remuneration policy, and especially when they don't really hear the voices of the investors very much because they're not too keen to go out and meet them, or as we do it nowadays through screens. But also in terms of poor strategy and trying to change the strategy and capital allocation. So I think in other markets, maybe the activism is a little bit more interesting in terms of the issues covered. I don't know if I pass the word to Andrew on this.
Yeah, absolutely. Andrea, what do you see in the markets that you cover?
So I'll leave Australia for you to discuss, but I also deal with Japan and Korea, and it's certainly very interesting times in Japan when it comes to ESG activism and shareholder proposals. There's been a little bit of a trend earlier on where utility companies and so forth might have received some shareholder proposals to stop using coal-fired plants and so forth, or denuclearization. It is the Japanese market. It's quite easy to get a shareholder proposal onto the ballot. I'll just preface everything with that. While we haven't seen yet a say on climate style proposal, from last year, the first real climate disclosure and climate change shareholder proposal was submitted to one of the big banks or financial institutions, Mizuho, which was basically improved. They wanted improved disclosure around how the company aligns their strategy with the Paris climate goals and the 1.5 degrees Celsius scenario planning. So in Asia and Japan and Korea are a bit the same, although Korea's been quite a bit more sophisticated with their blue chips in terms of broader sustainability reporting, but they're struggling a bit with TCFD. They're great at saying, this is where we're at with emissions and so forth. This is where we want to be. But there's no timeline, no strategy discussed of how we're going to get from point A to B. So I think that's where the shareholder activists are coming in from, particularly in Japan. So in this just finished proxy season in Japan, there was Sumitomo, another financial institution, Mitsubishi UFJ also received similar style proposals to Mizuho around improved disclosure on climate change. And then Toyo Seikan received ESG proposal similar as well, but it was actually issued by Oasis Asset Management rather than at the financial institutions. It's being done by other activist groups and civil society groups, environmental groups and so forth, who've got a bit of a track record both domestically and internationally in pushing these. They've all not passed, but Mizuho got 34% last year. I think Mitsubishi was 24% support and Sumitomo was 20 or 22%. I might have got the last two confused, but it was around that 20-24% mark. So I think it's been a bit of a wake-up call for the Japanese market, who are already, we're definitely seeing with our clients, a very keen interest to understand foreign investors' perspective on ESG. And when we're talking ESG, it tends to overemphasize the E aspect and wanting to understand the different ESG rating agencies out there, what influence they have on their share register, there's so many different types of disclosure frameworks, what do they need to be doing and how they need to be doing it better. So I think there's signs of significant improvements in Japan, although it's very early stages. They are questioning and wanting to know more about the Say on Climate movement because they understand that could be a thing in Japan. While Korea, I think they haven't received those sorts of proposals yet. They understand the need to embrace ESG and adopt TCFD and so forth, but it's still not as pressing. But there was quite a big high-profile proxy fight there. Typically, proxy fights are about dividends and pushing for buybacks and so forth, with a little bit of G mixed in as a rationale behind the dissident. But we did see one where there was quite a strong ESG, broader ESG strategy they wanted to adopt at this company. So it was a very, very close outcome. So it does show that, and this was coming from a domestic dissident, so it does show that it's taking a hold in Korea as well, just a bit different to what we're seeing in other markets outside of Asia Pacific.
And Andrew, is there any engagement happening, or what are we observing in terms of engagement between companies and investors, especially when it comes to these specific issues?
Yeah, it's still, as I said, very early days. So I think there's a willingness to engage from our clients. Sometimes it's difficult to get the engagement, but there's also a hesitancy because they're not fully confident in what the expectations that their investors have on ESG. But we're starting to see companies trying to do, in Korea, there's a few companies that have been doing ESG roundtables with their investors and foreign investors in particular, also doing ESG roadshows and understanding that investors now, particularly the larger ones like a BlackRock or Vanguard, it's not, I think they've had engagement in the past, but it's with the portfolio managers and so forth, and it's not really touched on ESG. And when they have tried to talk ESG, they're not the right people to talk to. So there's a bit of a growing understanding that there's two approaches to engaging with investors.
Absolutely. Very different situation compared to Australia, where obviously engagement, especially on when it comes to environmental and social aspects, has had quite a long tradition. Notwithstanding that, we haven't really seen many shareholder resolutions, especially on ESG, I would say 5, 6, 7 years ago, but they started popping up around Paris Agreement and afterwards. And what we're seeing now is a steady number of shareholder resolutions lodged at mainly large companies, mainly companies in mining, oil and gas, and banking sectors. And the resolutions relate mainly to climate change disclosures, setting targets, emission targets, as well as human rights, labor rights, and lobbying activities. What was quite interesting for the Australian market in 2020 is that for the first time, we have seen a support of almost 50% of issued share capital that voted. At one of the mining companies, the resolution was around climate change disclosures. And getting that high level of support obviously prompts companies to rethink how they go about their climate change disclosures and other disclosures as well. There was also a resolution asking a specific company to set a date for closure of their coal assets. And what was really interesting about this case is that none of the proxy advisors have supported this resolution, yet the resolution received around 20% support from investors, including BlackRock, who was public about how they went on voting with this company and providing reasons why they've supported this resolution. So it's quite interesting, and I think again it's unprecedented compared to 5, 6, 10 years ago, and how investors interacted with companies, how especially investment managers were voting. In the past, we've never seen investment managers voting against directors or supporting shareholder resolutions. Nowadays, they're more than happy to express their dissent and their unhappiness with how a company is performing or how a company is disclosing through lodging negative votes. So the times have changed. There's much more pressure and much more scrutiny put on companies. Just while we're on topic of shareholder activism and ENES resolutions, Andrea, is it difficult in Germanic markets to lodge a shareholder resolution, and are we seeing similar trends in continental Europe?
I think we've seen about 2 or 3 years ago the first German companies being confronted by shareholder proposals, and the legal framework at the moment, as this is not subject of an annual general meeting, did not make it happen. So we have not seen any shareholder proposals in the Germanic markets on, say, on sustainability or any ESG topic. But what I would like to add in addition to that is the activist investors in particular, I think they've undergone a very, very quick education process. While, 10 years ago, they leveraged on governance topics that the big key large institutional investors cared about. Nowadays, they leverage on ESG topic, and in particular TCI, as you mentioned, Jana, and their campaign for, say, on climate. I mean, TCI, I think, was the first hedge fund in Germany that I think in 2004 or 5 initiated the campaign at Deutsche Börse when they were planning to merge with the LSE, and it was, the big invasion of the low costs in Germany. And now we're seeing the same investor, going for, say, on climate topics. So in my view, it is really just another leverage for activist investors to jump on. And of course, they're going to gather much larger support than in the past. And whether this will be, seen as a real impact in the Germanic markets, I can't say yet, because as I just said, in Germany, the legal framework does not really leave much room for the possibility to have shareholder proposals on such topics. But also what we heard from Patrick regarding Spain, and not much opposition on a standard voting item on, say, on sustainability. I think it's really the investor accountability that matters going forward, and this is what the engagement has to focus on, and also what companies have to tell a better story about.
Couldn't agree more. Couldn't agree more. So we've got 5 minutes left until the end of the webinar, and I did want to share some of the sort of findings and looking forward statements that we've also provided in our investor survey. But I did want to open up to the audience to see whether there's any questions that might have come through. And I apologize, I can't see them. So if anyone can see them and you can read them, then we can answer them. Do we have a question? If anybody's asking, you might have been on mute. No, we don't have any questions.
Yes, there is. Hi, hello everyone. It's Elena. So Jana, there is no question in the chat, but there is a request to send the presentation, so we will follow up with email. Thank you.
Absolutely. Thank you, Elena. So with that, if we don't have any questions, what I wanted to ask our panelists today is to just conclude with maybe one key recommendation that they have for Morrow Sodali clients, for Morrow Sodali prospects, and any listed company stemming from the findings of the institutional survey. And maybe it's a one do or don't, or any sort of recommendation that you think that would be good for companies to consider. So maybe let's start with Andrew.
I think taking control of your engagement process on ESG. Don't be afraid to engage with your investors on ESG. But if you're a company in your early ESG journey, engagement's really important early on to find out from your biggest investors what they perceived are your material topics and issues, so that you both understand you're on the same page. But you might find that what they think is a material issue, you might not, or vice versa. They might have said something that you find to be a material issue. So it helps you to start the whole process a lot more cleanly, so you know what to focus on in your disclosure and what you need to try and communicate and articulate to your investors.
Thank you, Andrew. Patrick?
Jana, Jana, sorry to interrupt you. We have a question from Anthony Reich. So can I? So
yeah,
to what extent are we seeing hedge funds investor showing sensitivity to ESG issue when deciding which funds to invest in or not invest in?
It's a great question. And look, in terms of hedge funds, it's really, I wouldn't say difficult to pinpoint specifically, but obviously, as we mentioned, Chris Horn, one hedge fund manager, very, very focused on climate and activist himself. But overall, at least from my perspective and my experience in the APAC region, hedge funds are currently not that very focused on ESG overall. It's mainly, the investment managers as well as asset owners, and especially in the APAC region, we've got a big cohort of pension funds or superannuation funds that are very, very focused on ESG, and they are making majority of their decisions based on ESG. There's also positive and negative screens based on ESG now. And I do think that this will send a massive ripple effect throughout the whole investment community. We obviously still have retail investors, high net worth investors, and other investors who are very value focused, and they will always just look at the share price and your short-term performance and your total shareholder return and quarterly performance, and that will always be here. But I do think that when it comes to investors who invest for long term, they will increasingly be incorporating ESG in their decisions, and they will be stricter and much more sophisticated when it comes to applying ESG in their decisions. I don't know whether Andrea, Patrick, or Andrew had any other insights or comments.
No, you covered it nicely.
No worries, thank you. So just going back to some of the do's and don'ts and recommendations, Patrick, did you have any words of wisdom for our audience?
Well, just in terms of just the experience I have from working with companies for the last 7 years, it's just the companies that plan their AGM a year ahead, including their engagement with proxy advisors, even perhaps going back once you've called the meeting to go and speak with the proxy advisors. Obviously Glass Lewis you can't, but ISS you can, and some of the top investors. I mean, if you have a very clear calendar when you're going to speak to everybody, it saves a lot of problems, and you just have such an easier time if you plan ahead. And also in terms of remuneration, if you speak to investors before you actually close your remuneration plan, I mean, then you can just save yourself a lot of headaches. And the remuneration consultants are great, but it's good having a partnership with people who know how the proxy advisors and the investors are going to react to that. And then just quickly, in terms of ESG reporting, we have that saying, KISS, no, keep it simple, stupid, because as we discussed with Glass Lewis a couple of weeks ago, the people that are actually reviewing your corporate information just don't have time to go through fancy reports, and so just make it very easy for these analysts to find the information.
Very good point, very strong point, absolutely. And Andrea, did you have any words of wisdom for us?
Yeah, I try to keep it short as we're running short of time, but I remain to say what I always like to say, that engagement is the best defense. And as Patrick just outlined, be early, be in time, make sure you address all the important topics. And when you talk about ESG and also when you deal with ESG internally as well as in the external communication, make it as integrated as possible to not have, ESG as something, but, show how sustainable matters in your strategy, in your compensation, and in your board. And I think then you are well prepared and all set. Thanks.
Couldn't agree more. So with that, we're 2 minutes over, but hopefully you stayed with us. Hopefully the session was helpful, enjoyable, and you have taken lots of insights that you will be able to apply in your day jobs. On the next couple of slides, we've got contact details for the panelists. In case you have any questions or you would like to contact us, please do not hesitate. With this, I would like to thank our panelists, Andrea, Patrick, as well as Andrew. And thank you very much for your time spent with us over the past hour. Take good care of yourself, and I look forward to seeing you at our next event. Thank you. Have a good day and have a good night.
Thanks. Bye.
And thank you, Jana. Bye.